13 years ago, Greece was rated as junk. Now, it's on its way back to investment grade. In today's video, we'll be covering how the country turned it all around economically, what this means for them, and what we can expect from the Mediterranean underdog. Scope Ratings upgraded Greece's position to investment grade, demonstrating the country's improvement in restoring its public finances 13 years after it became the first member of the Eurozone to have its credit rating downgraded. They've gone from a BB+ to a stable BBB-. With this, the debt crisis that broke out in 2010 and required 3 international bailout programs has finally come to an end. More than 10 years after losing that significant credit rating, Greece was close to recovering investment-grade status for a while, signaling a stunning turnabout for an economy that had been shaken by the Eurozone's sovereign debt crisis. A statement from the Greek Finance Ministry read out that, "This is the second upgrade of the Greek economy to investment grade in a week, a development that further strengthens forecasts for an upgrade by the end of the year, also by rating agencies recognized by the European Central Bank." The high profile of public debt, fiscal performance, structural reforms, and NPL reduction are among the factors that contributed to the step-up. Greece is definitely unique when it comes to the ups and downs of its economy. Right now, the economy is expanding at a rate that is approximately 3 percentage points higher than what we anticipated for the Eurozone. Looking ahead to 2024, we see the margin narrowing to just about 2%. But even at that level, the economy is still expanding far more quickly than its counterparts. Also, Greece expects its inflation to decline faster than that of its peers. So, overall, Greece is providing a really solid readout. The MSCI All Greece Select 2550 Index returned 3.53% in 2022, compared to a loss of -19.81% for the MSCI Emerging Markets IMI Index and a loss of 18.13% for the S&P 500 Index. Despite Greek stocks' reputation of being volatile, how they did in the past doesn't mean they couldn't get better results in the future, and they proved it. At this point, you want to make sure to subscribe to our channel so you don't miss out on any latest news. Their GDP is expected to continue increasing more quickly than the average for the Eurozone, outpacing it by almost 300 basis points last year. Also, there have been positive marginal GDP revisions, and government officials emphasized that over the last 3 years, economic growth has consistently exceeded expectations. For instance, unemployment has dropped to 12%, the lowest level since 2010 and well below 2019 levels, and the nation boasts perhaps the most aggressive fiscal consolidation among EU countries since the pandemic. What's more, the debt-to-GDP ratio is decreasing and is now close to 170%. A reviving tourism industry, recovery and resilience funds, and a good election outcome all worked well for them. Imagine, Greece is starting a capital expenditure cycle with help from years of underinvestment and recovery and resilience funds seeping into the economy, while many other countries are slowing down growth in the face of inflation. Now, EU member states must create plans outlining the reforms and investments that will be funded with the RRF in order to be eligible for funding. Such plans, referred to as National Recovery and Resilience Plans, must be evaluated by the European Commission and approved by the Council. Greece was a pioneer in this program and expects to receive more than 30 billion euros by 2025. They've already received over 10 billion euros, and the government has already approved projects totaling more than 3 billion euros. The majority of these initiatives are focused on exports, tourism, green energy transition, energy efficiency, and digitization. The basic line is that Greece seems to be stepping on the gas while the rest of the world is seeing projects postponed due to rising interest rates and slower growth. Let's not forget that 20% of Greece's GDP is made up of tourism. Officials anticipate that this year's levels will return to those of 2019, which will be fueled by a strong U.S. currency and huge pent-up demand from a reopened China. The recuperation began slowly and gradually. Keep in mind that the Greek economy lost more than a third of its GDP between its peak and its low point in 2013. So after a few years of slowly growing, it started to climb back slowly as well. The fact that so much of the GDP was lost is not surprising, because growth in terms of a nation's capacity to invest, develop capital, and increase productivity will be difficult to achieve. Of course, COVID hurt the economies of most nations, and Greece was no exception. But what has transpired after COVID is really inspiring and rather unexpected. Beginning in 2021, but particularly from 2022 onward, Greece's economic activity has been exceptionally solid.
JWP 专注全球华人的海外资产管理。